Hey everyone, Nick Nielsen, Certified Financial Planner. I had an awesome conversation with a 60-year-old couple yesterday, and he was asking about stocks, and at age 60, should he still own stocks, and if they were too risky. So I'd like to go to the whiteboard and just kind of share with you what I shared with this couple yesterday and how I think about if stocks are risky. So I'll just draw kind of a basic T-chart here. And on the bottom, we'll just think about this as time. And then risk will be our other axis. So let's think about a 60-year couple that historically has a 30-year time horizon or a 3-decade retirement ahead of them. And let's just think about this 45-degree line here as the grinding power of inflation. Right? At 3% inflation, $1 million today needs to grow to about 2.42 million in the future to have the same purchasing power. And after all, isn't that what we're all about? So when I think about stocks, they are incredibly risky in the short term. Right? Stocks can drop 40% in a diversified portfolio in the blink of an eye. Now, over time, I argue that stocks, as you get outside the blast zone, are less and less risky over time. And I'll use the historic number of the worst 30-year rolling period for the S&P 500, an index you cannot invest directly in, but it's a good proxy for the best companies in the United States, well capitalized. The worst 30-year rolling period is 7.8% annualized rate of return. So stocks for a short period of time, incredibly risky. We do not want to have any money in stocks that we're going to need in the short term. However, when we think about cash has very little risk in the short term. The only way our account balance goes down in a checking or savings account is if we go in and withdraw money for some reason. However, over time, I think about owning too much cash or safe stuff as incredibly risky to a portfolio because it's very unlikely that it will keep pace with inflation or exceed inflation by any meaningful rate of return, which kind of goes back to our approach when we think about how we invest money for our clients. And we use the acronym of 6, 5, and 4. 6 just stands for we want 6 months of cash set aside for emergency expenses. So if it costs us $5,000 a month to live, we would want $30,000 set aside for cash. Next, we would want to set around 5 years worth of portfolio income in our fixed income investments. So if this investor needed $3,000 a month from their portfolio, 3 times 60 would be $180,000. And the rest, a little tongue-in-cheek, we would want that money invested for growth. That is our money for the long term. So whatever the balance is, we love that money to be invested for growth. And that goes back to risk versus volatility. Stocks, yes, very risky in the short term. They're volatile. But the real risk is not owning stocks for the long haul or having too much safe stuff that you keep in your portfolio for meaningful periods of time. Allocate to cash, fixed income, and stocks based upon what you need your portfolio to do. So we always say your dreams determine your plan determines your portfolio. The portfolio is nothing more than the funding mechanism for your plan. If you found this video helpful, it would mean a lot to us if you would like and subscribe to the YouTube channel. And in addition, I think the very best thing that we do is our Dollars and Diagrams email that goes out every Saturday morning at 9 a.m. If you're interested, sign up in the show notes below. Thank you.